of India's booming markets. Can you imagine volatility with the precision of a master strategist? I'm thrilled today to introduce Anup Maheshwari, co-founder and chief investment officer at 360 ONE Asset. With over 26 years of dominating India's investment landscape, from his stellar tenure at DSP BlackRock to pioneering bold strategies at IIFL, Anoop turns opportunities into wealth with unmatched vision. Today on the interview with me, Ayesha Faridi, he's right here to answer what's next for India's markets and investors. Anoop, welcome to ET Now. Thank you so much for your time.
Thank you, Ayesha. Thank you very much.
So how does India prosper? Because I remember pretty much the same time last year, you were warning all the investors out there, go easy, we may hit a consolidation patch. And boy, we have. It's almost been a year, and it's only, now that you're seeing the markets pick up very sectorally, albeit. Is the next year going to be the same, or can we see some cheer building?
So a lot has changed over the last 12 months, Ayesha. I think 12 months ago, we were a bit more cautious because the macros weren't particularly favorable. We had entered into a zone where there was a lot of tightening fiscally, monetarily as well. We had a reserve bank that was, fairly aggressive in terms of controlling credit growth, and earnings were looking like they were struggling. In fact, for the last 4 quarters, we've seen earnings being downgraded quarter by quarter till the last quarter. So a consolidation, I think, was the need of the day. Valuations were also high last year. We've seen valuations adjust downwards. And I'd say all of those factors that we were worried about last year have pretty much reversed. So monetary policy has become very, very easy with the new RBI governor in place. Interest rates have come off. Fiscally, we started giving a boost to consumption. We've seen what the government's done on income tax as well as GST. And earnings, we think the downgrade cycle is over. And we probably see minor upticks, but at least no further downgrades. So in that sense, I'd say we're more positive than we would have been 12 months ago. We still have to digest a bit of overvaluation, I would say, depending on which sector we're talking about. So it's not going to be necessarily all broad-based. But I think bottom-up, this market's looking a lot more interesting now. It also helps that relative to the rest of the world, India had outperformed massively when same time last year. In the last 12 months, other markets have caught up a lot while India has gone nowhere. So India's relative standing from a relative to the rest of the world point of view has also got a lot better. So on all counts, I would say more positively biased than the same time last year.
Yeah.
But again, I'd just temper expectations. This is not a runaway bull market. I think we are back into that 10 to 15% type of return expectations.
The one thing, Anoop, which when I look back at the year, the one thing which really stayed put was the DII money. The SIP money continued to flow in, continued to support the markets. While that part is taken care of, and I completely understand about the financialization of savings, which is currently at play, what about the HNIs and the ultra HNIs? Because you would have a closer, sort of ear to the ground with that faction of the market. What are they feeling about it? You think another year of consolidation and sedate returns, what would they do with their equity holdings?
So HNIs, again, there's a constant cash flow that they're experiencing either through their businesses or a sale of a business. So to our mind, there will always be some sort of equity allocation that would occur. Over the past 12 months, we've seen a lot of people also diversifying a little bit, investing overseas. That's become a bit of a trend with the ultra HNI community. We've seen a lot of investments into property, real assets. But equities will always be a fairly decent mainstay of their entire net worth. So we haven't really seen too much of negative action from an HNI point of view. It's been sedate as the market has been. And we notice a correlation. When markets pick up, even HNI interest starts picking up again.
So is now the time to build up and invest more into equities, looking at a 1 to 2 year time frame?
Yeah, in a way, it's always a good time,
for sure,
depending on your time frame. But yeah, I would say we're a little more positive now, again, than we were 12 months ago. I think valuations are still a bit above where you would ideally like it to be. But we have to also see valuations in the context of interest rates, which are lower. So lower interest rates result in slightly higher valuations. So yeah, it's a decent market. As I said, we're back to that 10 to 15% potential expectations of returns when you typically look at this asset class. For higher than that, I think our valuations will have to be a bit lower.
What would lead to that? I mean, do you even see those trigger points that would ease down valuations?
I think our concern is more global on that front, Ayesha. I think domestically things seem to be reasonably well set. But globally, from when we look at sort of parameters, particularly in the US, the concentration in the top 10, ownership, wealth, market cap, and the fact that a lot of incremental cash flow in the US, in fact, they're not all the incremental free cash flow is going now into investing into hardware and data centers and stuff like that. Our concern is that the return on capital of those investments will be very subpar initially. And I'm not sure markets would appreciate it at some point in time. So there's a bit of a bubble there for sure. And whenever that bubble unwinds itself, it could have a repercussion across, it tends to impact global markets, somehow or the other. So I think that's maybe a concern at the back of one's head. But I think domestically, we're feeling a lot more